Hello everyone and welcome to TBS Financial Channel. Today we're going to be talking about very important financial instruments, bonds. Bonds in a nutshell is a financial instruments that allows issuers such as governments, such as corporations, it could be banks as well, to borrow money on the financial markets, what we call debt market. In return of borrowing the money, they can give, and actually they do give, coupons to the investor until maturity, which is the time by which the investor will get his money back. So there are two main features that are important with the bonds: maturity, which is the time by which the bond is paid in full, and the coupons, which is the return that the investor gets when they invest in these bonds. Coupons could be fixed or floating, and then we will have fixed coupon bonds, which in general we call them fixed income securities. And fixed coupon bonds, they trade at par, and by par we mean if the notional is, let's say, 100, they trade at 100. They could be above par. For example, if the notion is 100, they trade at 110, and they could be below par, which we call a discount. So above par it's at a premium, below par at a discount, depending of the value of the coupon, which is fixed, and the interest rate that is dominating the market at that time. If the interest rate equals to the coupon, then it trades at par. If the interest rate higher than the coupon, then it trades at a discount. And if the interest rate is lower than the coupon, it will trade at a premium. This is not the case of the other category of the bonds, which is a floating bond. Floating coupon bonds are bonds that they have coupons that is floating. So it's always trading at par because you always have the interest rate equal to the coupon. Now, bonds can also have more sophisticated features. Bonds can have some options with it, and we call them bonds with embedded options, such as callable bonds. So for some bonds, the issuer have the option to buy back the bond for himself, and that's what we call callable bonds. We have bonds with that option to convert the bond to an equity, and that's what we call convertible bonds. And there are many other features of bonds. We can have different kind of bonds like index-linked bonds, so bonds where the coupon is linked to an inflation index, for example. We can have actually bonds without coupons, zero coupon bonds. Zero coupon bond, en fait, vu que ما تعطيش coupon. This is for investors who really think the interest rate will go down, so the price will go very high. It's the most sensitive bond. خاطر كي عندك دي كوبون كبار كأنك رجعت فلوسك شوية من الأول. كي ما عندكش كوبون بالكل، كل اللعبة في الآخر. دونك كان لي تو دانتيري طاحوا، هي باش تلها السوم هيطلع بالكدا. Which interesting for the issuer. علاش؟ على خاطر ما يخلصش. Donc l'investor, if he's thinking that the interest rate will go down، خاطر ما تعرف اللي كون لي تو يطلعوا السوم لوبليغاسيون يطلع. اور اوبليغاسيون عندك كوبونات كبار ما يطلعش بروبورسيونيلمون كيف كيما تطلع زيرو كوبون تطلع للسماء. Donc if he's betting on the interest rate will go down, they will buy zero coupon bond. والإيشيور تقول انت مشيرة الإيشيور شنو يحب؟ يقول لك انا ما نحبش نخلص العوام الاول، برشا ياخذوا حتى دي ديلي دو غراس، واحد يقول لك انا تو ما عنديش فلوس حتى يجوني الفلوس ومن بعد كان نبدا نرجع. Donc that's the interesting part for that. We can have amortizing bonds, which means that for every period of coupon there is a part of the notional is paid back, so you don't have to wait until maturity to get your money back. So as you can see, there are many different kind of features of the bonds, and that's not the purpose of the video today, to get into deal with all these features, but at least you have a broader view of what kind of bonds we can have. Now, as we saw in the debt market video, we can have different kind of issuers. We can have government bonds, we can have municipal bonds, we can have corporate bonds, and we can have mortgage bonds, etc., etc., etc. Let's understand a little bit more about how the bonds trade. There are some important dates for the bond. There is what we call, the first one is the trade date. And the trade date is the date in which the transaction is done. It doesn't mean the payment is done. It means the transaction is done. The date where the payment is done is called the settlement date. And that comes few days after the trade date. In general, that's 3 days. It depends on the market, 3 days after the trade date. So it's like we call them T plus 3. Now, the other important date that we mentioned earlier quickly is the maturity date, is the date by which all the obligation of the issuers are done. So the investor will get all the money that he lended plus all the interest, which is a coupon, that he will get during the life of the bond. Now, another feature that is very important with the bonds is pricing. There are two prices for the bonds that some people might find confusing, but let's explain it clearly. This is what we call the dirty price and the clean price. The dirty price is the price that you pay as an investor to get the bond, is exactly what you pay on the settlement date. The clean price is like the dirty price, but doesn't take into account the accrued interest, which means that the dirty price is actually clean price plus accrued interest. And by accrued interest, we mean the interest that you earn between coupon dates. So the difference between dirty price and clean price is the dirty price is that's what you actually use for transactions, and the clean price is if you want to know what's the price without having the effect of accrued interest. Bonds are not as risky as stocks because bondholders will always get paid before stockholders. Bonds still have some credit default risk because you have different companies, they have different risks, and that's why many investors go back to credit agencies to see what kind of ratings that they can get, and the ratings go from the best rating AAA to the worst rating D, which is default, and depending on the rating, bonds will have to offer higher coupon, higher interest. The riskier the bonds, the higher the coupon they have to offer. I don't want to get into much detail about default risk. We will see this in a different video in the future about credit default products, and hopefully this was clear for you. That was a quick overview concerning the bond market, and see you soon on TBS Financial Channel.